months, the same momentum can continue, whatever is happening. But you've seen any time, you see 99, although we say it peaked in 99, it went and peaked, the tech sector peaked in maybe March of 2000. Similarly, infra sector, although it was actually infra and all really came to a sudden stop at the end of 2007. But generally, you would expect without any big events that the same thing continues for 2-3 months. And then some things happen, some things change. Maybe when the new government comes in, you feel that too much expectations are already in. And even if they do the things that you want or think they will do on PSUs, like it happened in 2014, the PSUs in the second half didn't do well. Actually, if you look at 2019, where the win of the BJP was quite big, actually the market didn't do too much. It finally did well only when the tax rates were cut in, I think, September of 19. So all I'm saying is don't expect the same, but broadly our model has been that all the time some 1/3 of the market is doing very well and you don't exactly know which one. But if you buy 30, 35, 40 companies, you cover every angle that you can, and then you gain some and you lose some. But in the end, gain more than the market. Yes. Hi.
Morning. This is Rima here. In your flexi cap fund, you also have some new age tech companies. I think you're betting on Zomato and Paytm. Now, Zomato has done exceedingly well. Last year the stock doubled. But on Paytm, towards the end of the year, there were some regulatory clampdowns, which is hurting their business. How would you approach Paytm, and would you look to widen your investments in these new age tech companies beyond these two stocks?
So first thing is, I'm not the fund manager of the mutual fund, but Paytm is I also own in the offshore fund, so I can say that the market was a bit harsh and this thing won't work so much to be so harsh, because basically if a company on its own wants to cut down on something, obviously based on the environment, and saying that I don't want to do this anymore because the environment is saying like, but we are not doing badly in our own actual lending to that portfolio. I believe they have said in various forums after that they'll be able to demonstrate that it was not their own portfolio that was doing badly. Second thing is, if you look at the market cap of Paytm, I think it's 32, I forget, but I think it's some 30 or 1,000 crore, which is like $4 billion. And this has become like Xerox or like other things, which has become, a word for doing payments by phone. Which other business, new age business, is at $4 and $5 billion? You look at even Nykaa is at some 7-8 billion, and all those, which have not become as one-to-one with the business of their industry. And I think so. Paytm, I think, is good. We have added a little bit here and there, maybe 25 basis points, then another 25 across different funds. I like it a lot.
Okay. Samir, let's talk financials, because I think one consensus trade that everyone seems to be going with is that quickly load up on private sector banks because they haven't run, and FIs will come in, and then we know what happens. A, do you believe in that trade? And B, beyond the large cap banks, what else are you expecting from financials this year? I mean, NBFCs have had a bit of a rough ride, a lot of regulatory changes there as well. Would you look at something else? Would you look at insurance, asset management? What beyond large cap banks in 24?
So asset management, we believe enough to have started our own asset management company and put in maybe 100 crores in it. And that also personal. So that is clear. But, the trade of the big banks, I think, is the easiest. Now, if it doesn't work, I don't know, that'd be very disappointing. But the real thing is that if there are three big themes in India, which is IT, consumer, and financials, from every angle, relative and absolute performance and the stock price performance, the financials is the easiest trade. What would you rather buy? A company which says that my earnings are growing 15-20%, but the stock price is flat, or companies in IT sector where they say that we are growing 0, but there might be a recovery and we might grow at 10% next year, and the stock prices are up 30-40%. If you look at the IT sector from 2019 March to now, so you look at the earnings and you look at the cumulative earning growth from 2019 March to say 2024 March, these guys have grown 60%, 70% cumulatively in earnings. And some of them have grown 100%, and the stock prices are up 3.5 times, 2.5 times, basically much more. And again, next year, the earnings growth best expectation is 10-12%. The financial guys have been always growing at that rate. and you get them at prices which are 2-3-year-old, and they're a big part of the market. So I think that the foreigner, if he comes, and that is the key part of the story, whether he underweights, overweights, he has to buy 25%, 28%, 30% in financials, which is, if they're putting in 20-30 billion, which is what minimum we would expect, that means they have to put $5-6 billion into these stocks. And so they should outperform. Now, if they don't, we'll see. But we also totally agree. Actually, I've been one of the earliest ones in this for 1 year saying that FIs will come and buy, but they haven't come, or they have bought in the last few months, but not before. I think it's the easiest trade.
And Samir, HDFC Bank, towards the last quarter, we kept asking you, Samir, what's happening on HDFC Bank? You said it's one of your top holdings. And towards the last quarter,
number one top holding.
It came to the party. Number one top holding, that's the one that you
not
told
one of the top holdings. One of the top is different.
It is the top holding. Is the top holding. So you believe 2024 will be much better? I mean, fundamentally, yes, things are looking good. But,
so, I don't like this idea that many people say, oh, when you buy a stock, it should be so painful. If it's painful, you'll make more money. It's absolute nonsensical thing that these people do. Not you. I'm saying people say that the stock should look that it's very tough and then it should do well. No, sometimes it should just be an obvious stock and you buy it. I made so much money just buying the obvious things in life. And it looks to me one of the more obvious ones to do well. It doesn't have to go up 40%, but it has to go up 20%, 25% for a few years. Then I will be happy. But previously, it has done that really for all my working life. So I don't think.
So Samir, just to complete the point on financial, we get what you're saying. I think no gain without pain. I think that's something that holds true in the gym. Maybe in the stock market, you can just keep getting gains without the pain, and that's fine, right?
We have suffered the pain for 2 years.
That's also true. You waited.
Didn't do well. Yeah.
Yes, you waited patiently.
But just to say that now it's obvious, it doesn't matter if it is obvious. I think it's obvious and good. And just before I came in, your person said, are there any disclaimers? So I hope the disclaimer is obvious that we own the stock across every point.
No, we'll put the disclaimers out. But just to complete the point. It's the obvious disclaimer. Just to complete the point on financials. So, okay, this is the obvious part. Large banks, which you already own. Give us your sense on anything else. When would you stay away from NBFCs? And what about insurance? Insurance has had such a volatile 2023. The stocks move up and down with every regulatory change. Now there's some talk that, the surrender charges will go up and then the stocks fall and then some tax change will happen. So what do you do with insurance?
So I don't own it in the mutual fund. They own SBI Life. I don't own any insurance company. I like obvious trades. I'm a lazier guy than all these guys. But we own NBFCs. Even Paytm is an NBFC. We own smaller banks also. And we own a few NBFCs. So broadly, we like the sector simply because the earnings growth is easiest to see. The quality assets, the quality of lending is easy to see. And although at the margin, somebody might say that, there has been too much hype in small loans and all, it still is small only in total absolute quantity. And I think we can maneuver through that and these companies can go through that somewhat more easier than other places where the macro is not working in the sense. I don't think IT guys will in any way please the markets in terms of their guidance or their results. And the consumer mostly will be disappointing if it is not catering to the upper end. So the real growth is going to come in financials of all kind.
Samir, any other obvious trades apart from HDFC Bank? And you spoke about Paytm. Anything else that you would be comfortable with?
No, Paytm I'm not saying is obvious. Paytm I'm not saying is obvious.
HDFC Bank is an obvious trade. Is there any
ICICI and HDFC Bank are obvious. The other obvious trades might be on the other side, that many stocks that are up primarily because the markets are up, even though, by the way, my mutual fund may be owning them, I don't know. But broadly speaking, I think that somebody, whether it's SEBI or it is the stock exchange or it's the government, will put some complications on these futures and options trading and all these things, because it is just too blatant. It is too obvious, because here what happens is that if the market comes down, say, 20 days before elections for unrelated reasons, it just leaves a bad this thing in the market. And main thing is that if something is very obvious, then the system comes hard on everybody, including on the regulators, on the exchanges, saying, didn't you see that in the world, the ratio of futures to cash market is, say, pata nahi how much they say, 4:1 or something. And here we have 501. What did you want? Did you want 1,000:1 before you would come in or something like that? So I think the conversation is already started, if you see just in the papers and all, that it is a bit too much. And this amount of punting by everybody is not healthy for anybody. Everybody thinks that they are going to be financially independent. So sorry to break your heart, but this cannot get you financial independence like this. So this it will be done just because the systems work like that, where you have to protect the overall sanctity of the market. And the speculation cannot be so in your face. I think it is too much in our face.
Samir, just a quick 30-second answer before we wrap, and we'll be, we have our next management also waiting. But just wanted to ask you this: in your circles, in the chatter, when you go around the parties and just the chit chat on this absolutely breathtaking PSU run, are there still believers out there, or are people saying let's lighten position? But just what's the approach, given what we've seen in 23 on PSUs?
Over the year, we have also bought 5-6 PSUs. We had only, say, 2.5 before. Yeah. I always had State Bank and Bharat Electronics. And then then we bought HPCL, then we bought another bank, then we bought IRCTC. You know, there at least you started from very low valuation, and even now somebody can justify it. But again, look at the QIPs of these banks. You know, at the last minute, that QIP size went up. I forget how much. It was some 4,000 crore QIP. And in the end, some 80,000 crores of orders were there. I mean, this is totally wild. It actually, because I've seen this for too long, makes me feel that don't call it too much interest, too much money waiting to be in the market. You have to just call it too much speculation. And too much speculation doesn't work. So from that angle, but not against PSU, this is against the market in general. PSU, somebody can still justify saying, you know, they had not done well for so many years, so now they have done well. And even I'm saying that for some of the stocks that I own, that these are the only way to play these themes. If you want to play the fact that there is a big investment in railways, who wants to buy these capital intensive L1 type of which guy will get what order by the guy delivering food to all these trains and go on and booking tickets and move on. So that all depends. I don't think PSU per se people are saying is too wild or too speculative, but overall market, everybody's.
Samir, great conversation. Thank you very much for joining in, and look forward to many such delightful conversations in 2024. Well, let's get to Bajaj Auto. They just reported their December auto sales. The company has reported a 16% jump in its total sales in the month of January at 3.26 lakh units. But this is slightly lower than the Nomura estimate, which was 3.5 lakh units. To break up that 16% growth that we've seen in January, domestic sales have gone up 28%, while exports have seen a growth of only 2%. Rakesh Sharma, the Executive Director at Bajaj Auto, is with us on the show. Rakesh, Rima here, morning, and wish you a very happy new year to you, your family, and everyone at Bajaj Auto. Just provide some more color on the January sales. We've got the numbers with us, but how did premium do, mass market, what is the retail uptick looking like, and then the guidance and the outlook for the month of January?
Good morning and very happy new year to all of you too. December was a great month. Usually, December following on the heels of the festive period of October, November sees a big drop. We did not see that big a drop, and it was in line with our strategy, which has been to, as I've been saying, which has been to focus on the top half of the industry. And I think over there, even in December, we outpaced the industry in domestic motorcycles by almost 2 times. So giving a further expansion of market share in that very strategic 125cc plus segments. The newer businesses like Chetak did well. We continued to garner market share, and supply chain kept expanding its performance. So we breached the 10,000 mark from a registration point of view in December as well. So that was very good. There was no sort of fall off in the Triumph sales, which also again augurs well for the coming months and quarters. So December retails were almost entirely equal to the festive period, November period sales. The three-wheeler business, keeps marching on with its market share at 80%, expanding the CNG and growing the electric three-wheeler component in the business also. Exports, a marginal improvement in the quarter over the quarter two. So we are hoping that the macroeconomics and the geopolitics starts to turn positive in the coming quarters. We are well positioned to harness any improvement over there. But for the moment, it's a watch out. We are still watching the export front.
All right. Good morning, Mr. Sharma, and good to see you in. Wishing you the best for 2024. Nigel on this side. Well, I want to ask you about the exports. I understand your various parts, brokerages, they were wondering whether or not there was some container issue which was impacting exports. It could be temporary in nature, but is that true?
Yeah, good morning, Nigel. Happy New Year. You're right, because of the little fracas in the Red Sea, we did face some disruption, and the shipping companies have been quick to increase the freight rates a bit. But you're also right in observing that it is not going to last, but for the moment, yes, shipments were delayed to some parts of Latin America and Africa.
Okay, all right. And also with regard to exports, as you said, it's an improving trend. Of quarter three will be better than quarter two, and quarter two was better than quarter one. You expect the improvement to continue? If you could give me clarity on that, point number one. And point number two, since you're outpacing the market, what is the updated market share in both the categories, the 125cc plus as well as the domestic market?
So certainly we expect quarter four to be better than quarter three in exports. But, the caveat is always the volatility in the currency market, which seems to be easing up to some extent. But then you also saw things like the major devaluation in Argentina, which is an important market to us, for us. And Nigeria also still a little bit restive over there. So, however, like you said, the trend is the things are calming down. Now, what's the rate at which things return to normalcy is something which we can only wait and watch. But I expect quarter four certainly to be better, marginally better than quarter three. In the
domestic market share you're giving us,
So the second question which you asked, our market share from a retail registration point of view in domestic motorcycles in the top half of the industry is now running at 31-32%. So it's very, very close to leadership. I don't have the exact numbers as to what happened in the last couple of days, but that's the region in which we are operating, and we are, of course, looking at a number one spot in the months to come. We're well positioned with the entire Pulsar range now almost refreshed, and a few more launches going to hit the market rapidly between now and April, every month almost. So there will be a lot of activity, and I think that should provide us a good boost to wrest leadership of that segment.
Just getting back to the point about exports, and did you lose any? Was there a loss of sales on account of the Red Sea disruption? So you all did exports of 1.35 lakh units in December. Would that number have been higher if it weren't for this disruption?
No, not really. There was no loss. There are some delays, but there are channel stocks. So as yet, the disruption has not affected us materially.
And what's been the total Triumph sales so far for you now since its launch, and what are the bookings looking like for the future?
Well, the retail number is about 2,500 units. We are running at that rate, which is what the number for November was also. And this is, in the 40, 45 odd stores which have been sort of newly launched. So it's not an all India number. And quite significantly, some of the areas we are already starting to see market share of 15 to 20% levels. Again, from a Vahan registration point of view, in important markets like Kerala, we're not there across Kerala, but Trivandrum, Cochin, we are striking above 15%. Bangalore, certainly above 15%. So wherever the store footprint has expanded and people have had the time, like say 2-3 months to sort of start talking about the brand and activate things locally, we are seeing a very good movement in our market share. We will continue to expand, and we are hoping to sort of close the next quarter by almost doubling the store network which is there today, and that should sort of boost our retails quite a bit.
Mr. Sharma, finally, just to end with, let's get a big picture sort of projection for you. We are speaking on the 1st of January. I think for the calendar year that's closed out, I mean, total sales were up about 7%, with some recovery in exports. At this point in time, do you have some rough projections that perhaps we could work with? The new normalized run rate for exports, I mean, will it continue to be in this vicinity of 135,000? And also just give us a sort of a, crystal ball look ahead. 2024, is it going to be, more about rising volumes? What about competition? What about just the way you think pricing trends will play out, particularly in the premium end, which is where, of course, Bajaj has a lot of dominance?
Well, I can say that, as we enter 2024, I must say it is, after quite a while, very promising from where we are standing, both from an industry point of view. Our class of customer seems to have returned. There is certain optimism, and there is a little bit better purchasing power. So the economic recovery is finally reaching our class of customers. We are very well positioned in terms of, I just spoke, a refreshed new range, a very throbbing pipeline of products which are going to hit the market. And what happens is, whenever there is optimism in the market, and with that backdrop, new product introductions always get you a lot of mileage. So to that extent, the ducks are pretty aligned as we see it for the forthcoming months. The newer businesses like Triumph and Chetak, which we really started to get our sort of supply chain and our front end in position, they've got validated, accepted, and we are now looking at a period of scale up now. So we are from, getting our act right and getting the basic apparatus right. We are now moving into a phase of scaling up these newer businesses in 2024. The exports recovery, like I said, is really, there is not much we can do, and we don't want to sort of do things which will counter macroeconomics. I think, we have steadfastly kept to our pricing and margin profile because we don't want to use that bit to counter exchange rate volatility. So from a mix and from a margin point of view, the export business is extremely well positioned. It's just that the volumes now completely depend on the recovery of some of these key markets, which a few green shoots are there. So when you put, and on the other side, at this point of time, we are not seeing a huge pressure from, or we're not seeing a pressure from the cost side. So when you put all these things together, it does look promising.
Yes.
My fingers are crossed. There shouldn't be any geopolitical or macroeconomic disruption. We should navigate the election period properly.
Sure.
And it looks like a good time for the industry.
Thank you, Rakesh, for joining in. All the very best for 2024. Get into a break. On the other side, we'll be joined by Gangadi Madhukar Reddy, MD and CEO of MedPlus Health Services, to discuss the recent drug license suspensions. And we'll also connect with Govind Singh, MD CEO at Utkarsh Small Finance Bank, after RBI asked lenders to curtail credit deposit ratio to 75%. Stay tuned.
Welcome back. Here with us on Corporate Radar. MedPlus Health Services is the next company on our radar. Now, this company has received several orders for drug license suspensions across various states. To talk about the impact of this on the business and, of course, the outlook going ahead, we have with us Ganga Di Madhukar Reddy, Managing Director and Chief Executive Officer at MedPlus Health Services. So thanks for joining in. Good morning to you. Season's greetings. And first of all, wish you a very, very happy new year. We just want to start by understanding... Thank you so much. We just want to start by understanding the nature of these orders. You know, December 20, order received for suspension for a drug license in Telangana for 5 days. On December 22, there's a suspension in Karnataka, Tamil Nadu, Andhra. Why so many drug suspension orders? And what's the impact that this is likely to have on the business?
Sure. So we have over 4,200 stores. And in all these stores, we have got pharmacists who are working day in and day out. There are times when, you could have a drug inspector walk in and maybe not have all the regulations or all the paperwork in order or something like that. And for that reason, you end up, sometimes getting a suspension for a few days. For us, it is not material. And that's the reason why we did not actually report it in the past. These things have been happening for a while. It is only now that the SEBI has actually said that irrespective of the materiality, you actually have to report all these things, and hence we're doing it. But for us though, in a year, if we basically shut down maybe even 30, 40 or 50 shops for 4 or 5 days, that's less than one store shutting down out of the overall 4,200 stores. So not really material, I must say. Not that we are happy with the way it is, we're trying to improve it and we're trying to make sure that we are in line with all the drug rules, but definitely not material.
No, exactly. I was just coming to that. I understand you're saying it's not material, but when you add up all the daily shutdowns, is it what I'm guessing 1% of sales, maybe less? Can you give us the quantum? And also, then there's a sentiment issue here. With the disclosures now coming in, investors will want to know why this is happening, and more importantly, how do you mitigate this? How do you ensure that whatever these disruptions are because of paperwork, as you said, how do you ensure it doesn't happen?
We are actually putting in better IT systems and all to take care of a lot of these things out there in the store. And I wouldn't say we have to live with some of these things, but this is the nature of the business. But better control, better IT systems. That's all there is to it. We are working on it. And as I said, even if you add up all the things, it doesn't even come to one store shut down for one full year. And that's out of 4,000 stores. So it is way less.
So while it's not unusual and it's happened in the past, has there been at least an uptick in the suspensions or no?
No. These things happen. No, I really will have to go and look at all the numbers to see if there's uptick, but happens from time to time between different states. I don't think there's a major uptick.
Okay. So how is business then on the diagnostic front? How many locations are you operational in right now? And do you have a target for 2024 by the end of next year?
Diagnostics, as I have mentioned in the past, is still in the pilot stage. We're there only in one city. It's a subscription model. The plan is to basically sell insurance-like subscriptions to the entire city, which means you need a network covering the city fully. And that's why, whatever money we invested it only in one city. So we'll probably continue to be that till we get really comfortable with the number of subscriptions and all, until we get comfortable about the overall acceptance of the plan itself. So for now, no immediate plans to move out of Hyderabad. Yeah, if that answers your question.
Okay, all right. Hi, sir. Good morning and good to see you. And, you had also entered that generics med segment. And out there, you were looking at gaining some market share, but there was some discounting as well. So give us a couple of aspects then. How is offtake and what is the current discounting trends out here?
Based on volume alone, the uptake has been fantastic. We started in Telangana nearly 4 or 5 months ago. We started end of June. And these numbers are out there in the public domain anyway. We were at around 2.42 crores per day in Telangana when we started it. By the end of September, we basically reached 2.83 crores. So massive uptick, I would say. We have products available for roughly around 55% of all the medicinal needs. So what that means is, exactly what that means actually. And we have seen an uptick of almost a third of that. So 18% of all medicines today sold in Telangana region or from the MedPlus brand. Uptake is great. Now, as I said, it is volume growth. Obviously, if I am selling a drug which I would otherwise sell at, let's say, 100 rupee MRP drug, our usual discount was 17%. We'd have sold it at 83. Instead, today we're selling it at 40. Obviously, the top line is going to be slightly lower. The margins are not affected though. On the same 100 rupee MRP drug, we actually make slightly more than what we would make on the branded generic. But the volumes have gone up significantly.
Mr. Reddy, give us the store rollout plan as well, and also the geographical sort of focus that you'll have. I know that you've been opening beyond the southern states. There's a MedPlus store near my house here in Mumbai now. So what's the total store rollout plan for FY24, and also just a sense of how revenues might move, given what you described, given that there's the generics play coming in and a lot of this discounting, but you're saying that margins will be up. So what does that translate into revenue growth projections for this year, 24?
I think they're still going to be in line with what we had actually earlier said. I don't think there's going to be any major difference out there over last year. But what I would really like to focus on is this. While store growth is has always been there, will continue to grow out there. That's not what we are really looking at right now. Think of it this way. In India, 80% of everything we actually sell is all generics. These all have been off patent for several years now, some of them for decades. We didn't have a large enough store which had its own store brand to actually make it and sell it. So what we sell from MedPlus is on par with any of the top guys out there. In a lot of cases, it could even be better, but it's definitely not inferior. We don't have any of the marketing costs and all, and hence we are able to give this massive discount. We're seeing a fantastic, uptake out here. We think now, for the first time, with the way the Prime Minister's Jan Aushadhi program is going, and the overall awareness being created around the generic products and all, and the fact that MedPlus is now, now has the scale to actually buy and basically get the drugs made and sell them in our own stores, and thereby disintermediating some of the companies out there. I think the industry itself is going to change significantly. I think that's going to be the story this year. Whether we add, 500 stores or 1,000 stores, I don't think it's going to be so.
No, that's a very valid point, and we'll definitely keep an eye out on that. So, while we talk about that growing generic story with some of the government partnership programs, I just want to go back to the revenue picture of the first half of this year. You've done about 2,700 crores. How are you likely to close out the year?
It'll be slightly better. Second half will be slightly better. That's all I can tell you. Yeah.
Okay, all right.
Even your margins have improved in the first half of the year to 6%. What's the outlook on margins?
Again, marginally better, I would say, mainly because a lot of our stuff is now private label. And so the margins are going to be slightly better. It is not as, the current set of private label which we have is obviously not as profitable because we're giving 40 to 60% discount out there on all these drugs. But overall, since these are actually displacing the branded generics on which we make far less, we would actually make slightly better margins as we go forward.
All right, Mr. Reddy, what about the big investor in there, Lavender Rose, which is Wabag, I think.
Yeah.
What is their plans with regard to their holding? Do you think in 2024, at some point of time, majority of this holding will be sold, or have they indicated they want to hold it for a longer term?
I see no reason to, really believe that they want to, at least my conversations with them have not led to any conclusion on that part. But as a private equity company, I mean, they will want to get out of the public market sooner or later. They also hold a significant chunk right now, along with Premji Invest. So between both, they hold roughly around 20%. So I see that they will take every opportunity to sell down a little bit. I don't think they're going to be selling down everything in one shot for sure. So maybe, yeah, in the course of the year, they could sell a little bit. Okay,
all right. And also, I think you're taking approval, right, to go ahead and raise some money. Could you tell us what is the plan out there? Will we hear about a fundraise in the coming quarter or so? If yes, what could the quantum be?
See, it's an enabling resolution. We wanted to basically put it in place to take advantage of the market and all. But the company itself, I'm not really sure if you really need the money right now. Till I decide to really expand on the diagnostic side, we are funded by internal accruals. We don't have any debt. So any growth plan which we have can easily be funded. I don't think we'll, So till that happens, we're not really going to.
So as of now, it's just an enabling resolution. You're not expecting to go ahead and raise these funds, right?
Okay.
Okay, and that includes the expansion on private labels, on the generics, the big plans that you spoke of. You said that will be the story of 2024-25. So all of that funding will be internal accruals. Is that right?
We have no debt at all today. So if you really want to get some, working capital loan, we can go and pick it up easily. I don't think that's really going to come in the way.
Okay. All right, Mr. Reddy, we will leave it on that note. Thank you very much for joining in, and good luck to you for the new year that is upon us now. With that, thank you. Let's move on now. Last week, colleague Abhishek reported that RBI has likely asked some banks to reduce the credit deposit ratio to below 75%. RBI did respond to CNBC-TV18's query, confirming that it has asked some banks to lower the CD ratio. To assess the impact of this development, Govind Singh, Managing Director and Chief Executive Officer at Utkarsh Small Finance Bank, is with us now. Mr. Singh, thank you very much for joining in, and season's greetings to you. Wish you a very, very happy new year. Hope it's a very positive year for you, all your stakeholders, and of course, personally as well. Your first thoughts on the lowering of this CD ratio. I mean, have you heard from the RBI at all, and what do you make of this?
Yeah, thank you, and happy new year to you and your team also. So normally, if you look from the control angle, RBI always expects that CD should be in the range of 75 to 80%. And, when we started the bank, and that is true for all the new, you can say converted banks who are earlier NBFC, they become bank. It takes a little longer time for them to reach a certain CD ratio. So normally, the regulator looks at 75 to 80%. And certainly they will ask, banks to go towards that, that trajectory. But normally they will be also understanding that it will take around 5-7 years time to reach that level. So for established banks, for sure, they are in that range. For newer banks, it will take some time. So generally, they will be expecting us to below 100% right now. And that is true for, new banks, whether it is SFB space or even the new universal bank. And that's the trend, and that will continue to be there.
Mr. Singh, morning. So what is your current CD ratio, credit to deposit ratio?
So I'm, it's very difficult to give numbers here. You are aware of,
or a range?
Because from today onward it's difficult. But the only one thing I can say, if you look at our Q2 numbers, so it was close to 100%, and it has come down significantly year-on-year basis. And the trajectory continues. In fact, it is coming down on a continuous basis. Our reliance on deposits is more and more on for our advances. In fact, if you look at our quarter two numbers, also we are a net lender. We are always a net lender in money market. Also, there is no money market exposure, and our borrowings per se have come down during this financial year till H1.
Okay.
So the trend is in that direction.
And how many years, sir, will it take for you, in your assessment, to come down to 75-80%?
So normally, as I mentioned, what has been happening, and the way we expect, because you grow and you build your franchise also. My sense is it should take for banks maybe around another 4 to 5 years to reach around 80% or so. And there will be a gradual decrease on a quarter-on-quarter basis.
All right, Mr. Singh, let's talk about a couple of numbers. I recall, in most of your interactions that you have been maintaining that the second half of the year, the NIMs will improve as fresh disbursements will be happening at fresh rates. Do you hold on to that for the second half of the year? What kind of improvement can we see in NIMs? And also, I think you were guiding for a growth of close to AUM growth of around 30%. Does that hold out?
Yeah, so both the things, improvement in NIM maybe around 15-20 basis minimum will certainly happen in H2, as we had guided in while having an earning call for H1, quarter two rather. And similarly, our growth of around 30% plus for this financial year, that also holds good, the way we had guided in the end of September.
All right, give us some more clarity on the AUM breakup. The micro banking AUM, I think it used to account for around 85 to 88% of your total business. That's come down, I think, to the mid-60s. Where is that number headed in the coming years?
True. So, as I mentioned, at the end of September end, it was around 62%. And we do expect this will further come down. And our, you can say, guidance is around, it will reach around 50% or so in next 3 years' time. And that again holds good today also. So maybe, you can say around 1.5% decrease on a quarter-on-quarter basis, that will certainly happen. So around 4 to 5% decrease on a on an annual basis in the micro banking book.
All right. On the credit cost side, I think you have a board mandated floating provision. So if you could tell us what is the credit cost likely to look like and how much of that, will you be accounting for because of this board mandate that you'll have?
So board has mandated that 1.5% of our micro banking, the microfinance book, we should create floating provision by March 24. So that we are creating on a month-on-month basis. So whatever our profitability numbers are there, whatever you see till September, and going forward also the way board has mandated and the way we have told investors also in our earning call, that will continue. So at the end of March 24, it will be close to 1.5% of our microfinance book in March 23, and that we intend to continue, because that gives you can say shock of the observer whenever there are decline or for any natural calamities also, we can always handle those things. So that will continue to be there. Our credit cost for quarter 2 was 2.3%, and we are yet to get the numbers, but we do expect that there will be improvement on overall you can say credit cost for the year when you look for the March 24. And I just want to mention this 2.3 includes the additional floating provision, which actually adds to almost 0.3 to 0.4% for the credit cost.
And it will improve from here, is what you're saying. So you end the year closer to 2%?
Difficult to say today. As I mentioned, it's very difficult to give any number today. But we are certainly expecting, as I mentioned in the earning call also, certainly expecting further improvements there.
Okay, all right. So we'll leave it on that note. Thank you very much for joining in. Good speaking with you today. That's Utkarsh. Thank you very much. By the way, the market's very quiet on the frontline indices. It's all about individual mid-caps. Mid-cap index is flying away, up almost 0.6% and lots of movers and shakers. I'll just throw some more names in, just to keep the screen buzzing. Look at Yes Bank, about 7% up. Railtel is up about 9% right now. Talk about more movers and shakers. You've got something like LIC Housing Finance, Irida, the recent PSU listing, IREDA, that's up and about. JBM Auto now 13%. That's the kind of gain it's clocking. Jyoti Laboratories, Olectra Green Tech, 4-5% up here. Very, very lively mid-cap screen. Though, of course, you can argue that volumes are thin, but then 1st of January, so we can't expect any more. Take a break on that note. We'll come back on the other side and find out what commodities are doing. The few markets that are open, what are the cues that we are getting in. We'll have Manisha joining in with the latest. Welcome back. As promised, we'll talk about the commodity market action now. Manisha Gupta is with us in the studios. Manisha, Happy New Year to you, first of all. Are there any commodity markets, global markets trading, or no? It's just like us in the equity space.
Well,
we're the Lone Ranger.
Not rub salt there. Well, yes, the volumes are really low internationally as well. Most of the international markets, the big exchanges where they are situated, those markets are also shut. So we're looking at lower volumes right now. But let's start with the good news, and that clearly comes in from the crude oil prices. India being one of the major importers there, we have seen crude oil prices decline by 10% in 2023. This has been the first annual decline since 2020. Last year, we saw the prices gain up by 10% as well. So what we are seeing is, a narrow range coming into the markets. There was a lot of conversation that we could be looking at $100 a barrel. That did not happen. The range that we saw in the previous year was between 70 to 96 on the higher side. There are, of course, concerns about increasing global supplies and weak demand, and that is putting pressure onto those prices there. So while the previous year's range has been 70 to 96, markets do believe that this year as well, you could be looking at that kind of a range there. The U.S. production is at an all-time high at 13.3 million barrels per day. We also have seen a continuous decline in rig count in the previous year, but that doesn't really matter because even as we are working with minus 157 of a rig count, last year was an increase of 193, and before that an increase of 235. So if you look at those numbers, we still are on the higher side of rig counts and production that is coming in from US as of now. The other thing is about record production that we also are not just looking from US, but from Brazil, Guyana and Canada as well. So the non-OPEC production is expected to increase. Within OPEC as well, as this new year and new quarter begins, what OPEC and allies did put out in sense of an agreement was a cut of 2.2 million barrels per day. If you look at that breakdown in various countries, the major heavy lifting is being done by Saudi Arabia at almost 100,000. We have seen Russia put in a big chunk as well. And then as we go down the list, it really is insignificant on what these members are doing. And also Angola leaving OPEC, the membership is something that has put further pressure onto those prices as well. When you talk about the outlook in the next year, well, the average outlook for Brent for the next year, the most bearish of it comes in from Citi at $75 a barrel. And then you have 80 and 85 is what Goldman Sachs, JP Morgan, Morgan Stanley are putting in at. The most bullish that we've seen on the higher side clearly is 90 to 95. That comes in from Bank of America to Barclays. But as I said, most of these brokerages and banks believe that 70 to 95 is where you could be looking at the crude oil prices for this year as well.
Okay, got that, Manisha. Thank you very much for the updates over there. We do have to take a break on that note. We'll come back on the other side with our special segment. It's The Economy. Lata will connect with Jayant Kumar Seal, professor at the Indian Institute of Foreign Trade, and Ajay Sahai, Director General and CEO at the Federation of Indian Export Organizations, to discuss this Red Sea issue, the roadblocks and the slight recovery now, and what lies ahead for India.
Welcome to the maiden edition of It's the Economy. Here's wishing everyone who's watching a fabulous 2024. Well, today we are going to be looking at India's export prospects in 2024. The world is blessed with continued strength in the US economy, but slowdown otherwise. A recession-prone Europe, property sector hit to China, and of course, war in the Middle East continuing to have ripples. In the latest news, Houthi rebels in the Red Sea have attacked a Singapore-flagged Maersk container, which has led the US military to sinking 3 Houthi boats. But for global trade, the worry is Maersk, which was one of the few global containers that continued to use the Red Sea, has pulled out its ships from the Red Sea for at least the next 48 hours. The world now possibly stares at 25% higher freight costs because of the Red Sea attacks. How will the near term and the longer term pan out for Indian exports in 2024? That's what we're asking our experts today. Professor Jayanta Kumar Seal, he's the Professor of Trade at Indian Institute of Foreign Trade, the Kolkata campus, and Ajay Sahai, the Director General and Chief Executive Officer at the FIU, Federation of Indian Export Organizations. Gentlemen, good morning and a very grand 2024 to you. All our good wishes.
Good morning to you and to a very, very happy new year to everybody.
Okay, Mr. Sahai, let me start with the immediate events. You know, we understand 300 of the 330 ships that were using the Red Sea had already moved out in the last 2 weeks of December and were using the Cape of Good Hope. Maersk was the only one which dared to use the Red Sea. Now they've also announced that they're moving out. What's the impact for us?
No, in fact, there are a number of obvious impact. A lot of exporters are holding back the consignment because they don't want consignment to be robbed or destroyed. Secondly, buyers are also telling the companies to hold back because wherever the contract is on the FOB basis, the freight has to be paid by the buyer. And since freights have slightly jumped and they are in the near future also likely to go up by 50%, they are holding back. Secondly, some of the shipping lines are now taking the longer route of Cape of Good Hope, which is definitely going to add to around 12 to 14 days to the voyage time. And this may help, this may basically affect the availability of container in the short term because the container shortage with a long voyage will be there. But what we are worried about that probably we are looking into a hike in the freight trade, not only for those who are operating this route, but overall increase in hike in freight rate, which 25% will be quite a moderate one. We are expecting it to go much because the kind of quote with the shipping line has given for the January and February, this definitely reflect a significant increase in the freight. So definitely it's a setback to the global trade, which in any case was facing a lot of geopolitical challenges, and probably this will cause a lot of logistic disruption also.
Okay, much higher than 25%, how much would it be?
We are expecting to go to around 50%.
Oh, okay, okay. Dr. Seal, to you as well, a very happy new year.
See, I don't see
your
that 25%. So what we have just collected, so freight charges to Yemen has gone up to $2,400 per container from $850 per container.
Oh.
Similarly, Jeddah. So we export a lot of basmati rice to Middle East and especially Saudi Arabia. So it has gone up from $300 to $1,500 per container. And Durban, South Africa, so from $700 to $1,200 per container. So what two of you are talking about 25%, it's not exactly 25%. It's much more than that, especially, for us, it's going to be a big challenge. And not only that, it has created some other problem in the domestic market also, since, basmati export has gone down. So naturally, price in the domestic market has also gone down. Okay, because the supply in the domestic market has gone down. So on the other side, sunflower, which is another thing which we import, that domestic market, the prices are expected to go up.
Oh, okay.
So because there is a problem
oil.
of, sunflower oil.
Yeah, sundrop would be a problem. Mr. Sahai, probably what you're saying is that the rates are very high, but people are staying away. they're not contracting. Do you think they can do that for long, or people will have to pitch in with higher rates?
Look into where we are seeing a significant jump in freight rate and where we are seeing the overall increase in the freight rate. What Professor said, I go along with him, because if you are using the Red Sea for supplying to a bordering country on the Middle East or in Africa or for the Europe or to some extent the east coast of US, prices may go up significantly, may go up to 75 to 100%. But overall increase in the freight rate is also seems to be on the card, because I don't think on the Red Sea, the shipping companies will be confident to start the sailing, because that may take some time. Even if one sporadic event happens, they will be holding back. Secondly, the increase in the risk insurance will be substantially high on these rates, both for the ships and even those exporters who are taking the marine cargo insurance. So from that perspective, a significant rise on this route and overall increase in the freight is also on the card. Secondly, I think we have to look into what are the type of contract. If there's a C&F and CF contract, probably the buyers will be forcing, or rather they will be telling the exporter to ship the goods. Where it's FOB contract, they will be asking to hold the books. And it's a difficult situation for both the sides. So in short, it is definitely going to have a little impact, little interruption in the trade. How quickly we can bounce back will tell what will be the scenario in 2024.
Okay. So that question to you, Professor Seal, is it like we are going to see a one-quarter disruption, or do you think that or I know I'm asking you a geopolitical question here, but what is the sense you are getting?
Just add one point which Dr. Sahai pointed out. See, insurance has gone up from 0.2% to 0.5%, which is quite a big jump. Okay, so the overall cost is going to go up. Now, India has already sent, some ships there, and America is also, attacking, because today, just now you started with, there is a Singapore-based ship which is attacked. Now, incidentally, since America has entered, hopefully Iran and Russia, which are indirectly supporting these, Houthi rebels. So hopefully Russia and Iran, they are not going to participate directly. But if they do, that will be a disaster. And so around 10% of the global fuel which comes from Red Sea. So just beside that, if you see the Gulf of Aden, so 25% of the world oil comes from Gulf of Aden. Now, Iran is sitting there. So if Iran, it's a critical case. If Iran also participates in the war, so that will be a disaster. So, and India, buys so much of oil. And one good thing, just we started with, the crude oil prices have gone down. One good thing is America has lifted some sanctions from Venezuela. So some Venezuelan oil is also coming to the market. So that's a good thing for us.
Okay. Yeah. Crude prices are at the moment at whatever, $77. So that is a very big relief. But Professor Seal, if you can just look down further for the rest of 2024, one hopes these disruptions are temporary. But as you say, the insurance and as Sahai said, the freight rates could be worse for the longer term. What is your sense about India's export performance for the rest of 2024? Are we likely to linger around this $33 billion per month for goods and about $28 billion for services? Or do you think that the year can be better?
See, my expectation is will definitely be better, because this cannot carry on for a long period of time. Okay, because India has already sent ships there, and it is taking a lot of actions. Okay, because that's a lifeline. Okay, this is one part. And if you talk about services, services for that probably you don't need Red Sea. But however, if your other trades are disrupted, services will also be disrupted. Now, India's service sector, one good hope, what do we see? You started with US is the only hope now. Europe is in a recession. But one good thing you will definitely appreciate that we have already signed a deal with Australia. So that's going to work well with us. Any day we can sign a deal with UK. and Singapore is also in the pipeline. We have already entered into services contract with trade contract with Middle East and many of the other countries in the Southeast Asia. Now, though our competitors are coming up, only thing is I see Vietnam, Cambodia, these are all small countries. Scale wise, we can always scale wise. In fact, like China. So China manufacturing, they beat everybody in scale. So scale wise, I don't think these countries will be our competitor.
So your export
I think we have a good
this year would be what, 5%, 10%?
If you ask me, I will say 5%.
Okay.
10 will be slightly, because it depends upon the global economy also.
I agree. And then we are seeing higher interest rates. Mr. Sahai, similar question to you. What are the early orders looking like despite these higher costs? What might you say would be the export growth in 2024?
Ma'am, I'm looking into the overall growth of around 3 to 4%. Last year in goods and services, we landed at $777 billion. This year, we are looking into $800 billion. There may be little dip in the merchandise sector, maybe 3 to 4%. But in the services sector, we are expecting around 14 to 15% growth. The good thing is that imports have also been subdued, and therefore we are looking into huge drop in the trade deficit. In fact, the trade deficit we expect this year to be lower than $100 billion. And that will be significant rate, because once we have the trade deficit coming down, probably the current account deficit, which everyone expect to be around 1.8%, will come down to around 1.5 to 1.6%. So overall, it's not a good, bad thing. And when you're looking into India's exports in comparison with other countries, probably we are doing much better. Many of our competitors are constantly showing the double-digit dip in exports. And therefore, it's a good performance. Of course, once we will have the backing of the better FTA and PLI scheme fully operating, probably we will have much more wherewithal in the manufacturing to support our exports.
Okay. Well, we will have to discuss the PLI scheme in another show. It's beyond the bounds. We are out of time here. But Mr. Sahai and Professor Seal, thank you very much for enlightening us. Near-term problems are pretty steep as far as freight rates and insurance rates go in the Red Sea, and that's a lifeline for India. But for the medium term, that is for 2024 itself, things should improve. But the export performance only expected to be about 3 to 5%. So it's not much that exports will contribute to India's GDP. It has to be domestically driven. On that note, thank you very much for joining us on this maiden edition of It's the Economy in 2024. Have a great year ahead, all of you. We wrap up on Bazaar. Chartbusters up next.